Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make investment decisions. The clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video, and all opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the 4 things we learned in the markets this week, starting with point number 1. And point number 1 is August, September, and October have not been fun months for the stock market. Cumulatively, they have actually kicked off the worst 3-month stretch since going back to 2020 when the COVID pandemic hit. And not so fun after we were riding a fun wave of success after the worst calendar year we had in 2022 since going back to 2008. However, everything feels better, or at least we're more comfortable when things are normalized. So let's not waste any time today. Let's go right into some charts. On your screen, you're going to see the calendar year returns for the S&P 500 index. Now remember, that's only the growth and income portion of the portfolios. There's also aggressive growth. There's also international that we typically allocate to. But this is just the growth and income, the S&P 500. And each year you see their total returns on the blue bar line, and you see a red dot. That red dot is the farthest intra-year decline we saw in any given year. So as of today, the S&P 500 stands at around 9%. Technically, after today, Friday's return, which was a little bit of a drop, we're sitting around 7%. But this was from a high of over 20% earlier in the year. And the largest decline we've seen this year is now over 10%. Is that normal? That's what we want to know. Is that normal? Well, over the last 10 years, there were 8 positive years and 2 negative years. Of those 8 positive years, 3 of the 8 saw declines of at least 10%. Technically 4 if you count this year in the last 10. So technically we should. So yes, of the 8 positive years we've seen over the last 10, half of them saw a decline of at least 10% intra-year sometime through the year. The point being, the stock market investing is bumpy and it's non-linear. It's simple, but it's not easy. Even in positive years, you have to be ready to ride the wave. So let's talk about now what we saw in the markets this week. Now, this week was an anomaly for me because we got pretty decent data across the board, including GDP growth, which we'll talk about in point number 2, and earnings results have been pretty good, which we'll talk about in point number 3. However, the market took it all in and continued its pessimistic draw it back down. In addition, we saw the 10-year Treasury yield, which is a proxy for interest rates, which has driven a lot of the trepidation in the market. They started the week at 4.86 and they ended the week about the same. So rates did not materially rise this week. So really good data. No material rise in interest rates this week. But here's what did materialize this week, and I think what's causing a lot of the problem. Mortgage rates. That's right. The average rate on a 30-year mortgage is now coming in about 7.79%, and that did take a precarious spike up this week. Yikes! The housing market, as we've continued to show, it's in a recession. All the data is pointing to that. There is no soft landing happening in housing right now. I was recently at a presentation with Blackstone, not BlackRock. I probably wouldn't go to a presentation by BlackRock, but Blackstone. Blackstone is the largest private equity firm in the country and, most importantly for this discussion, the largest owner of real estate in the country. In their opinion, we're about 4 million units, housing units, short right now, and that is attributed to the massive amount of pain on top of the high interest rates that we're feeling in the housing market. Now, when I say pain, that's a one-sided pain. Currently, only a small part of the population is probably feeling that pain, and those are people looking to buy a home or that just don't own a home right now. If you're a seller or an owner of a property, you aren't feeling this pain. You're actually getting the good side of the pain, which is the growth in the housing values. Let's look now at our weekly analysis for where we're at economically. First, we'll do that with the Atlanta Fed's GDP Now model. This is a gauge to see where we think the next quarter's economic growth will fall. First, look at it for the 4th quarter. And every week as economic data is released, this will continue to change and get updated. But currently, the Atlanta Fed anticipates GDP growth, or said another way, how much they expect our economy to grow by, to come in at 2.3% for the quarter. So another good, albeit normal, 2% is in the normal range for that, quarter of growth right now. And as always, the Atlanta Fed is above the consensus of Wall Street economists. Next, we have the initial claims for unemployment insurance we look at every week to check on the labor market and start to see cracks in that, if any. This week, they came in at 210,000 for the week of October 21st. So the number is staying within its historically low range. Nothing to see there. And finally, let's see how the markets did this week. The S&P 500, which is our proxy for growth in income, but only when taken together, as said above, that was negative 2.53% for the week. The Russell 2000, which is our proxy for small and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was actually negative 2.58% for the week. And finally, the MSCI EFA, which tracks international stocks, that took the prize this week because they made money, but they only dropped 1.08% for the week. With this week's drop, the international markets are actually now flat for the year. They've wiped away all their returns, leaving only the S&P 500 in the positive territory for the year. And again, that's only mainly attributed to the fact that 8 stocks in the S&P 500 have had outsized gains for the year, helping keep the S&P 500 good. The other 480, not good. Point number 2, third quarter GDP was released this week. Now, this is an important gauge because it's the primary indicator of how fast or slow our economy is growing or possibly sometimes shrinking. This is the sum total of all economic data happening in the country, and Wall Street economists were expecting a good quarter around 3.5%. However, the Atlanta Fed model, which is what I use to track current quarter GDP, not what Wall Street people are thinking, but the Atlanta Fed's model is what I use. We just looked at this a few minutes ago for the fourth quarter, if you remember, but the Atlanta Fed was expecting 5.4% as of the last reading. So who was right? Wall Street or my personal favorite, the Atlanta Fed? GDP Now model. Well, now you'll realize why it's my favorite. GDP was released and it came in at an astounding 4.9%. Wowzers. So the Atlanta Fed was off about 0.5%, and the average of most Wall Street economists were off by 1.5%. So to our point earlier, what happens when people feel like saving for a house is out of reach? Well, they're not going to save for a house. They save less and they spend more, and that propels the economy into a sugar high. I say that to say it's more than likely not going to keep growing at this pace because of what was the primary driver of GDP. And we'll talk about that in here a second. Although early reads are still predicting 2%. So what were the main drivers? Well, the main drivers towards this quarter's GDP growth was consumer spending on services. They provided the highest lift, as I just mentioned. Coming in second was a change in private inventories. This is companies buying up inventory for their business. And the most likely reason why this was so high for this quarter was many businesses either expect an uptick or at least a stalling around the 3.5-4% range for inflation. Therefore, they want to purchase a lot of their inventory now before prices continue to climb. The third was consumer spending on goods, not services, but goods, followed by spending by our government, city, local, states, federal, and residential investment actually did turn positive this quarter, but still very low. Business investment was pretty much non-existent. So props to my friends at the Atlanta Fed, and thank you for giving us this great tool. And now point number 3. The Wall Street Journal put out an article this last week stating that even while earnings season is shaping up pretty nicely, we're still seeing stock prices continue to drop. For the first time in 4 quarters, we're actually seeing earnings growth on average from companies, but you sure wouldn't know it from their stock prices. Even though they're growing their earnings for the first time in 4 quarters, their stock prices are not doing so well, as mentioned the last 3 months. Last week, we talked about many of the Magnificent Seven, as they're called, had their earnings reports this week. And again, those stocks are responsible for most of the gains in the market this year. All right. So Amazon was one of the ones that reported this week. They nearly tripled their profits thanks to strong results in cloud computing, advertising, and their retail business. The retail business is what most of us think about when we think of Amazon because that's how we interact with them in regards to buying things on Amazon.com. Additionally, mentioned Microsoft was going to have their earnings, and they had a pretty good week when they reported that they have accelerated growth in their cloud computing business as well, and they attribute it thanks to strong demand and a lot of optimism towards artificial intelligence, AI. On the not so good side, we said Google was going to be reporting this week. Well, Google's parent, Alphabet, did not have the best of weeks, falling because of weak cloud computing. That word just keeps coming up. And Meta took a large drop because of potential trouble in advertising, as well as a lot of spending on their virtual reality, which hurt earnings. In other companies, Intel had a decent week thanks to improvement in the PC market. General Electric used to be the biggest company in the US. We saw their revenue growth improve for a sixth straight quarter. Boeing, plane manufacturer, they had another quarterly loss, although not as much as expected after cutting 737 MAX delivery targets because of some production issues they had. All taken together, all the companies so far that have reported were on pace for a 2.7% year-over-year increase in profits. Now that's important because of this chart right here. With the S&P 500 trading at an 18.1 multiple, a gauge for how much you're paying for a stock relative to the earnings that stock generates. You can only see growth in the stock without getting PE expansion, multiple expansion, by seeing an increase to the bottom half of this equation, the earnings side. Now, as you can see, U.S. large cap does have the greatest growth potential outside of Japan and emerging markets, but notice in both of those markets, Japan and emerging markets, people are unwilling to pay for that growth, even though they have low PE ratios and a lot of earnings growth. And that's for many reasons. Japan, as they say, is a graveyard. They've done a terrible job of managing their demographics. And the emerging markets, as a community, have too many communist countries where it's just unsafe to invest. Point number 4. Finally, we received another inflation number on Friday. It was the Personal Consumption Expenditures Price Index, PCE. A nice word soup to say, as we've discussed a few weeks ago, PCE is a number that tracks inflation on what consumers actually buy as opposed to just the broad basket of goods that you see with CPI. The PCE measure is the Fed's preferred, it's what they like the most, method of looking at inflation. And the measure came in at 0.4% increase, which was the same rate of increase we saw in the month of August. So flat month over month, because these are September's numbers. Additionally, the core price, which includes the volatile parts of food and energy, they had a little more of an increase, up 0.3 from 0.1. So not more than the regular, but just more in terms of what they saw last month. Now, that was actually the core's largest increase since April. But as you see on your screen, a monthly reading of 0.1% would annualize to just 1.2% annually. So we almost expected to see a lift from there. That's why the markets didn't freak out over that. If you did annualize the actual number from using just April through September's numbers, you would come on the core side, you would come to a 2.8% reading, which is above the target of 2, but trending the right way still. Essentially, there is no surprise this week from any of the inflation numbers. And that, my friends, is some positive news. And again, most of the data, as we saw this week, when we break out GDP, we break out inflation, we break out earnings of companies. It's all pretty good data. The market's just not taking it as such. And that's okay, because the market doesn't always do what we expect. Long term, it comes to what the expectations are. But short term, there's just a lot of things that can move it, which is why if you don't like seeing a lot of movements, perhaps you should talk to your advisor to make sure you're in the right investments, to make sure that you are checking it at the right times, to make sure that you're not making irrational or emotional decisions. Because investing, as I mentioned earlier, it's a Warren Buffett phrase. It's simple. Just as Dave says, the 4 categories: growth, growth and income, aggressive growth, international. But why does Dave and why do Vanguard say? Vanguard says you need an advisor. Why do they say you need an advisor? The largest value that the advisor adds to you, according to Vanguard and Dave Ramsey and my calculator, is about 1.5% behavioral coaching, helping you to not do the wrong thing at the wrong time. It's so easy in our lives to say, when there's pain, I stop the pain. I make the pain go away. And investing, when there's pain like this, doesn't always mean you should make it go away. It's not a recipe for saying, just set it and forget it. But again, I've got good funds, good investments, ones that fit the goals that I have, then all this short-term movement, while I do want to understand it, hence the reason for these videos is trying to help you understand it, I don't need to make emotional decisions. So thanks so much for watching this week's video. If it was helpful to you, would you do us a favor? You can do us a favor by hitting the like button. The like button helps us with Google and YouTube algorithms, showing them that, hey, this content was helpful to you because you liked it. As well as you can hit the subscribe button. The subscribe button helps you get our content as it's released each and every week, whether it's our Question of the Week series or what we learned in the markets. As well as perhaps you'd like to sit in on a economic outlook that we're getting ready to do, where we're going to look at what's happened in the economy the last 12 months and what are some future projections for the economy over the next 12 months. We're going to be sitting down with one of the economists from First Trust, a very large ETF and financial services company, and we're going to just talk to one of their economists on what are their thoughts on what's going to happen over the next year, answer some questions that you probably want to know, and you will have a chance perhaps to answer a question or to ask a question or two of their economist. So it's going to be a great time. It's going to be on November 6th. We will put the link to sign up for that in the comments section of this video. So if you'd like to watch it, you just hit that link. We'll get you the invite so you can be there 4 o'clock on the 6th. Thanks so much. We'll look forward to seeing you next week.